ladies and gentlemen, moving on to our next presentation, Navigating Through Uncertainty, Market Outlook and Key Investment Themes by Mr. David Chao, Global Market Strategist, Asia Pacific of Invesco. A big round of applause, please, to welcome Mr. David Chao.
สวัสดีครับเป็นชื่อคุณเดวิดชาวมาจากที่ฮ่องกงนะครับผมจะเป็นลูกครึ่งแต่ว่าวันนี้มีกลัวพูดไทยแล้วครับถ้าจะพูดอังกฤษได้หรือเปล่า Okay, my name is David Chao. I am from Invesco. I am the global market strategist based in Hong Kong, but covering Asia Pacific. Previously, I used to live in Bangkok prior to Hong Kong, so it is always nice to come back. It's like a home welcoming to come back to Hong Kong, to Bangkok. So today I have a few key messages that I want to hit on. It's about how investors can position themselves in the time of uncertainty. And I also want to think that when you think about the longer term of investing, this is actually a very opportune time to invest. And hopefully at the end of this presentation, you'll have a better idea of what I mean. So the first slide that I want you to look at is where do we stand right now in terms of economic expansion? A lot of people have been saying that this is the longest historical expansion the US has seen, over 10 years. And if you look at the graph over here, it will show that the US economy expanded around 25% over the past 10 years. But that's relatively small compared to the larger economic expansions that we've had in the past. And then also compared to the EU has been expanding for around 6 years, but right now they're hitting around some slowdown in the European Union. Japan has also been expanding as well. But in terms of total economic expansion, we are in the longest period we have seen to date. Can this continue? Well, there are a lot of pundits, a lot of people that are saying that we are long in the tooth. Long in the tooth means that something is going to happen. The average business cycle in the US is around 3 years. So we have blown past that. We're at 10 years now. So why is there so much uncertainty about the potential future growth? Well, I will argue today that we are not going to face a recession anytime soon because we are continuing to see loosening monetary policy around the world. And so normally when you have looser monetary policy, that means interest rates go down. That encourages people to take risks, and that encourages economic activity. So all the recessions that we've seen in the past 5 times in the US, they've also been seen by an inverse yield curve. An inverse yield curve is when a short-term yield curve is actually about the same as a long-term yield curve, which means that borrowing in the longer term is actually more expensive than borrowing in the shorter term. But I will actually argue that the inverse yield curve and also a lot of the negative yielding instruments that we're seeing today is because of fear, geopolitical fear, okay? What I'd like to point out in this slide is that the US is actually growing above trend. And other countries such as China and India continue to experience high growth rates, but are actually growing below their trend growth rate. Whereas countries like Russia and South Africa, these commodity-dependent countries, they continue to grow at lower than expected levels. Whereas countries like South Korea, Mexico, they're very much impeded by global trade growing at slower levels. And so if we think about, comparatively speaking, we are in a relatively modest economic slowdown. This slide here talks about the trade war. And this morning, we had actually Secretary Wilbur Ross from the US, Commerce Secretary, who actually is in Thailand, in Bangkok, for the Indo-Pacific Summit. So that's happening up by Impact arena. And we have positive comments come from Wilbur Ross and also from the White House administration saying that we are very close to a trade deal. But you know the phrase, fool me once, shame on you, fool me twice, shame on me, right? So how many times have we been fooled about a potential deal? But I would actually argue this time around, there actually seems to be some material progress towards a trade resolution. Specifically, what we're talking about in the Phase 1 deal is, some of the more easy things that both Beijing and Washington can agree upon, such as the trade imbalance, as well as some framework around the RMB, as well as some of the issues surrounding IP protections. So these are some of the easier issues which I would argue would allow both President Xi and President Trump to both declare that they have a win-win situation. And so I expect a near-term resolution, a near-term deal. And this should actually be good for the markets. So what we saw the markets do today was actually rally into this news. And I expect some positive news flow from now until the end of the year. Actually, I expect positive news flow from both Brexit, the US-China trade war, and some of the Hong Kong protests that we're seeing. In, a lot of it, is happening on the weekends, but overall the trend appears to be moderating in terms of the number of people involved. So I would dare argue, I would dare say, we are in a period called the calm before the storm. Okay, so the calm meaning we are seeing some remediation on things like the US-China trade war. We have Brexit potential. The deadline has been extended, but it seems like the parliament is willing to accept the deal with the EU. And so I think because of these issues, these moderations, investor appetite for risk assets should actually grow. So I expect to see markets, especially in the US, in the UK, as well as in Asia, start to rally. We recently also saw a Federal Reserve in the US cut interest rates for the third time, another 25 basis points. And the reason I have this slide here is because I want to show what I previously said. Every time that we've had a recession in the past, it was because the Federal Reserve or central banks were raising interest rates, right? They were raising interest rates because there was inflation concerns, right? So when you raise interest rates, that basically discourages economic activity and has pushed the US into times of recession. But this time around, we saw interest rates being raised last year in 2018. And that's when there was a lot of fear that policy missteps from the central bank in the US would lead us into a recessionary environment. But we all know that has changed. Right? In 2019, the Federal Reserve reversed course, and instead of increasing interest rates, they have started cutting interest rates. And most recently, we saw the cut come last week. And the Fed announced that they stand ready to loosen economic policy, to loosen monetary policy and interest rates if things like the US-China trade war heats up. So even in the midst of potential uncertainties, and I expect uncertainties to continue next year, we have this countervailing force of central banks around the world, including the Bank of Thailand, including all the Asian central banks, to be cutting interest rates. And this should boost risky assets in the time being. If we think about where China stands, right, China is probably the most important player in Asia. And it's really important for us to understand what are the levers that the PBOC, that the Chinese government can do. And I would actually argue China is very different than the US, right? In the US, we watch the Fed very carefully what they can do. If they cut interest rates, and then some of the quantitative easing. But China is a different animal because Beijing is, they control both monetary policy, fiscal policy, industrial policy, state-owned enterprises, and so they have a lot of levers to pull. Right? So if the economy is slowing down as we see it is, the PBOC has 7 different levers that they can pull. Instead of just cutting interest rates, they can have all these other levers that they can pull to make borrowing cheaper. They can flood the market with liquidity. They have a lot of things that they can do. And so what we've seen so far is we've seen the reserve ratio requirement for banks come down. So this is an example of China loosening monetary policy. And what we can expect for the remainder, for the next 12 months, we're going to see China pick up in the fiscal stimulus. They're going to spend more money at the provincial level, building infrastructure. However, I would argue this fiscal stimulus, though, will have more of a domestic effect. So unlike the fiscal stimulus that we saw 10 years ago when China spent $1 trillion and basically lifted Asia out of the great financial crisis, China this time, that effect will not happen again. So the fiscal stimulus that China will employ this time around will have more of a measured, subdued effect. But if we have both monetary stimulus as well as fiscal stimulus, we can expect the Chinese economy to still grow in that 6% range. So I think that if we have both China and the US stimulating their economy either through monetary policy or through fiscal stimulus, that should actually benefit Asian economies like Thailand, emerging Asia. This slide again shows where we stand in terms of stock market performance as well as interest rate and monetary policy. So I have 2 examples, both here and here. So if we look at from June 15 to December 15, there was a peak to trough period of 14%. The S&P 500 index in the US fell around 14% when there were tighter conditions, when the Federal Reserve employed tighter monetary conditions in the US. And also, again, peak to trough. We all remember 2018. That was a horrible year. I think every asset class was down, right? And so peak to trough was negative 20%. But what did we see this year when we had 3 interest rate cuts? We saw the S&P rally. We saw all risk assets actually rally and do very well. So I would argue that we are in a period to follow where there are easier conditions and that risk assets should do well in this environment. So where do we stand in terms of the US dollar? So similarly, if we look at areas when the Fed is tightening, we see that the dollar rallies, the dollar becomes stronger, right? So higher interest rates, higher policy rates support higher interest rates, and global investors want to bring their money back into the US. But in the instances where we have the Fed loosening monetary policy, that actually has the effect of weakening the US dollar as investors around the world, they start taking their money out of like treasuries or out of the US dollar into places like emerging markets. However, I would argue this time around, because we are seeing central banks from around the world loosen economic policy, I expect the US dollar to basically remain currently where it is. The US dollar should remain relatively strong against emerging market assets, because emerging market countries, central banks continue to be loosening their monetary policies as well. So we'll see this synchronized global central bank monetary easing for 2020. I think that's a trend that we expect. Now, I'd like to look at emerging markets to be supported by attractive valuations. And if we look at where, the US stands in terms of valuation, the US is relatively pricey, relatively expensive. The S&P index is at a historical high level, trading around 20 times forward earnings. The average multiple is around 14 to 15 times, right? So it is difficult to make an argument to be sinking investments into developed markets like the US because of valuation. Now, if I look at other developed markets, like in Europe or even across the world, they're still relatively expensive. Emerging markets is relatively cheap. We are at a time point now where the gap between developed markets and emerging markets valuation is the greatest for 10 years. The last time we've seen such a gap in valuation was 10 years ago. Okay, so if you want to think about investing in a longer-term horizon, valuation does matter. Valuation and price does matter, right? And I would actually argue that Thais have a golden ticket right now. The golden ticket is because your currency is so strong, right? So it's much easier, say, for you to go to Japan for a ski trip or to Paris and buy, your Chanel purses, things like that. So think about longer-term investments in this same mindset as well, right? I think this is a golden opportunity when you can use the strength of the local currency to think about looking at other emerging market assets, right? Because you have both the benefit of a potential foreign exchange benefit as well as a valuation disconnect that we see right here. Obviously, a strong baht, some would argue, is not so good for Thailand's export-led economy, and it makes Thailand's exports more expensive. But I think that one could also argue that, with the US-China trade war, we're continuing to see some of the supply chain shift down to places like Vietnam, Philippines, and maybe we've even seen some pickup in foreign direct investments into Thailand. So I think that this is a situation where savvy investors, can think about how they can benefit from this dislocation right now. If we think about the global business outlook in terms of where economies are actually going, I would also argue that economies like India, we've seen the economy kind of tumble recently because of some of their credit issues that they've been having. But India actually is expected to grow pretty significantly in the next few years. So they're going to see kind of a V-shaped rebound. And China, although we continue to see decelerating growth, they're still the second largest economy in the world and still growing in the mid-single digits. And so the other countries like EU, France, they are decelerating to the extent that they're almost facing a technical recession, right? So Germany is very much impacted because Germany does a lot of trade with China. They sell a lot of expensive equipment to China. And the UK, Japan, actually we were quite interested in looking at these developed markets because there is some kind of dislocation, especially with Brexit on the UK. I think that some of the fears have been priced in already into UK equities. And then Japan, they recently instituted this tax on consumer staples, and so there's some speculation that this could potentially impact the consumption spending in Japan in the next month or two. But I think that it's an interesting opportunity now as we go into the Olympics. I think that the markets there should rally into next summer. Now, if we look at interest rates and inflation, I want to impart upon you that we are now in a low inflation, low interest rate environment. Low inflation and low interest rate. That's actually a pretty good environment for investors, especially with the longer term horizon, right? So where would you put your money? Would you put your money in negative yielding instruments like, a lot of the developed market bonds? Around 1/3 of the world's bonds are now negative yielding. So we wouldn't recommend you do that, right? Because I think that inaccurately reflects the fear of a potential global recession. But I've already demonstrated to you that I don't think that the recession is coming, although we're seeing the growth slow down, but a recession is not coming. So in a low inflation, low interest rate environment, risk assets such as equities should do well. Now, if we look at real rates, we'll see them declining in the US to around levels that we haven't seen since 2016. This year was the first time in 10 years that the US started cutting interest rates. Okay, we have to keep that in mind, that we are in this new paradigm where we should see continued easing in monetary policy across the world. And I can't emphasize that enough in terms of the impact that has on economic activity. Well, that was my last slide. I thought I had one more slide to go. But I'd just like to impart some of my final words. As I mentioned earlier, we like emerging market assets over developed market assets because of both the growth profile of EM, Asia, over the growth profile of, say, the US or the EU. We also think that the valuation disconnect is so great that it will have to garner investors to take a look at EM. And so if we think about the environment that we're in, I think that the risks have also moderated. And so I think that we have a window of time, right? So this is kind of the calm before the storm. So the calm, I think that it's a period that investors can think about where they want to position their assets. But I think 2020 will be another year filled of geopolitical uncertainties. And so I think that the Phase 2 agreement between the US and China, those issues are very, very thorny, and I don't think that they will be easily hashed out. So those issues are on things like forced technology transfers, as well as opening China's market access, and also enforcement of some of these agreements between the US and China. So these are thorny issues that I don't think will be easily solved. And we all know President Trump is unpredictable, and he loves to kind of throw on the tariffs last minute. I think the threat of that happening, again, is very, very high. Also, we have to think about the uncertainties of the US presidential election in 2020. And I don't think that the stock markets around the world are discounting a Democrat presidential president in 2020. So these are some of the political uncertainties that I think are very important, that will continue to stick with us. But I think that investors that stick for a much longer time period of investing, that remain diversified, and that look into assets where they can score a bargain, that they should do very well over time. Okay.